Hi, everybody. So this is the Shanghai chapter for the Financial Executives Networking Group. So today I'll be the host along with Jay Boyle. We are the China chairs for the FANG Shanghai chapter. And today we'll have a presentation with two guest speakers. And the objective here, we'll be talking about the latest global supply chain challenges so that everybody can gain the insights for 2023 strategic planning, including ways to get inventories under control. So part of the overview in here, of course, we're in an unpredictable environment here in China. There's concerns about scarce materials, people leaving, rising prices, factory shutdowns, long transportation times. So there's going to be some key takeaways, from this discussion, such as the latest supply chain challenges and key inputs for 2003, options for managing high inventories, and examples of how two companies, and we'll have some case studies of how companies have gotten control of their inventory in these type of environments. So let me introduce you to the speakers. Right now we have Paul.Stepanek. Paul is the founder and president of Complete Manufacturing and Distribution, which is a company that helps leaders worldwide accelerate results with Asia initiatives. Paul is a frequent speaker at international conferences and a media contributor. Paul is also passionate about helping leaders around the world craft a vision, reduce time to market, execute with agility, and drive business performance. We also have Brent.Terhaar, who's a principal manufacturing and distribution with CliftonLarsonAllen. And Brent is in the Minneapolis office for his company, which focuses on manufacturing distribution industry. Brent has over 20 years of experience serving the owners of privately held businesses in manufacturing, distribution, construction, and service industries. So without further ado, I will let you kick off the presentation. And Paul, you can share your slide deck to start.
Daniel, could you share the deck, please? And
yep, I'll share
next,
the deck.
Yeah.
Yep, Paul, I'll share the deck. I'm just going to share my screen here.
Okay, great.
And it should be shared. So Paul, I'll let you kick it off.
Okay. So looking at what's happening in the supply chain and giving some context to what we're talking about today, some years ago, we have a number of clients that were interested in shifting some of the eggs out of the proverbial China basket. Flash forward to some months ago, after we've been through 2.5 or 3 years of COVID, where people shifted from experiences into stuff, where a lot of stuff was made and shipped, with companies not knowing when the supply chain would break, they built up inventories to historically high levels. That's a situation that I think all of our customers are in, where they couldn't get enough fast enough and they over-ordered, not knowing when the supply chain would break or where it would break, and wanting to be in a position of being able to ship goods if it did break. So with that context, and then the backdrop of the Party Congress just completing, and where we are seeing potentially a shift in how we're thinking about supply chains, it's been quite a seesaw, where a couple of months ago, it was a very different discussion than it is over the past couple of weeks. Brett, next, please. So the areas that we're going to cover, and I'll go through it quite quickly, some of the movers that we see in the supply chain, what's happening with some trends, and what that means to the customers that we're working with, and I'll share those examples with you as we go on. Next, please. So without going into too much detail, essentially what we're seeing across all of the commodities, or most of the commodities that are involved in the products that we're dealing with, and I should say, I think a disclaimer, we're not involved in any of the very high tech kinds of things that are concerns with the U.S. administration at the moment. But we're more traditional widget manufacturers of metal, plastic, and low-end electronics. We're seeing commodity prices in steady decline. Next, please. Brent, yeah, thank you.
Yep.
In addition to that, container prices and the Baltic Dry Index, both of those indices are dropping. And it's just literally, I think, 45 days ago that we were seeing a 40-footer out of Shanghai going into Chicago at about $9,000. And as recent as this week, we're seeing prices that are $2,500. So roughly a third of what they were just literally a month and a half ago. I mean, it's from our standpoint, we anticipated that was going to be the trend. We had no idea that the bottom was going to fall out on pricing. Next, please. As you all, I'm sure, are following, there's quite a bit of volatility on the renminbi US dollar exchange rate. What we're hearing from financial institutions and some of the people that are tracking what potentially is happening with the strengthening of the US dollar is that potentially we could see 7.35 before the end of 2022, and then into the 7.5 territory within 2023. Obviously, everybody on this call understands that makes China products much more attractive. And again, it's not small movements, and we are anticipating that the dollar will continue to be strong. Next, please. From a contact that we have that is located closer to policy, apparently the U.S. administration has made a very careful calculation about whether or not it makes sense to be dropping tariffs. And the latest and greatest news that we have as of literally yesterday is that there's not an appetite to do that at this point. So we can assume that, I think, for the near term, that tariffs the Trump tariffs will stay in place. Next, please. So, as mentioned when we started out the discussion, inventory levels, we have customers that have imported, and this is where I'm going to throw in a couple of examples, imported historical levels of inventory to accommodate whether it's going to be a strike or a COVID shutdown or somehow, somewhere, the supply chain, which is, as everyone knows, is very complex. Some sort of breakage or shutdown within the supply chain, or ability to get materials, ability to get people in to do the manufacturing that needs to be done. And when we're dealing with complex assemblies with hundreds of parts, you're reliant on all of those different suppliers and all those different jurisdictions to make it happen. So we have clients that have rented extra warehouse space at a premium. Warehouse space, as you know, is quite high right now because of all the demand for it. And they've stuffed more inventory into those warehouses than they've ever had before in an environment where historically it's been more on the just in time, and we've moved very much into the just in case scenario. Now, interestingly, we have a client that we supply, and this is very traditional metal fabrication, plastic injection molding, complex assembly, some electronics, where we're supplying them not only with the components, and they have assembly facilities not only in the US, but also in Asia. And they have roughly 6 months worth of components already in the States, with another 2 months on the water. And looking into the teeth of recession, inflation, they want to slow down without creating a stoppage from their supply chain, which they know is very disruptive for the manufacturers. So even though that they want to pretty significantly reduce their inventory levels, they plan to do it over an 18-month period, so they don't completely shut down the manufacturing. So keep the manufacturing trickling, and shipping parts, but also getting to the point where they can get rid of extra inventory as well as the extra high cost warehousing that they have. Now, this same customer is also concerned about potential tensions across the straits. And they have also, at the same time that they're slowing the importation of components to do final assembly, what they're asking us to do is to increase assembly of the final product, which also happens in this case in China, and with the intention of building up inventories at a few key distribution points across the globe, essentially. So they're not sure where the friction will be within the supply chain, but with what's going on with the Ukraine Russia situation, as well as what's potentially happening in China, they want to make sure that they put product in a variety of places around the globe, so that they're not in the situation of not being able to ship to a market that still has demand. So that's one scenario. Another scenario, interestingly, is a different client, also in less complex assembly, but it's metal and plastic. And the assembly is largely done in China, with final assembly done in the United States, to shorten the lead time from the time that they say ship, which involves placing a purchase order, getting the product made, and then shipping it. We, over the last few weeks, have worked out agreements with their suppliers in China to be able to produce the product, warehouse the product in China, and then when they say ship, they can arrange for shipment within days rather than waiting for the whole production process to happen. And that also is a way to mitigate the costs of high warehousing costs on the U.S. side. And interestingly, in that case, we were able to get the suppliers to agree to warehouse it in China without any additional warehousing fee or cost. Let's go on to the next slide, please. A little bit about what's happening domestically in China. People are spending less. They're not sure about what's happening. They can feel the downturn. They're less busy at their jobs. They're seeing a lot less people moving around. They're seeing shopping malls and train stations that are operating at a fraction of what they're operating at, and they're far more reluctant to dip in their pocket to make a payment for something. And some of the retailers, as maybe a very rough indication, where some of the major retailers are seeing businesses being off by, say, 30, 40%, which is pretty significant. Next slide, please. This is interesting, and this data is banking data for what's coming into China as far as foreign direct investment. And even the statistics that we have for 2022 are reflecting that there is an uptick in foreign direct investment. And as we collectively scratch our heads, we're not sure where the money is coming from, or if it's being round-tripped, or if it was China money coming back into China being represented as foreign direct investment, because we are seeing, in general, the appetite for investing or making additional investments in China is not as great as this graph is demonstrating. Next, please. The COVID fatigue, if we want to use that word, is it's showing cracks, and people are becoming frustrated, and certainly staff that we have that are based in China are far more reluctant to make a trip that would be a domestic China trip than they have been, even if the area that they're going to is not an area that's a hot zone, so to speak, just because they might get somehow caught out or have to quarantine coming back, or that somehow it influences what they or their family would want to be doing. And so this is really a strain that we're seeing. Like I said, the cracks are starting to show through. Next, please. Are we able to get into China? Daniel and Jay are in a much better position to talk about that because they've recently made the journey. They are able, obviously, to get in. It is complicated. And then once you're in, what are you going to be subject to as far as quarantining? We have clients that went in a few weeks ago. They unfortunately tested positive the day after they arrived. Then they were treated to an expensive stay at the hospital and a regimen of vitamin C and other things that had them kind of scratching their heads. Anyway, it's complicated. And although we're seeing slight improvements with the number of flights and whispers of the number of days that people are going to have to quarantine, we're not clear on what that path looks like. We're hopeful that it will be less complicated in the coming weeks and months. Next, please. Of the 4 scenarios, and I'm not going to talk, everybody's welcome to read into this what they will. This is the fourth being one of great concern for people where they're not sure if their supply chain will somehow get dragged into it. I think is the one that we're hearing, certainly because it's being more often talked about in the media, and it's more often signaled about within both sides, on the government sides. So it's something that we're aware of. It's something that we're planning for. And I think that in general, where a few years ago, an appetite for moving something out of China was, well, as long as it's going to be competitive or close to. And I think the shift that we've seen in the last weeks is maybe pricing is although it's important, it's not going to be the major reason or the major blocking factor for thinking about other options as far as where to be sourcing product. Next, please.
Well, thanks,
Segue
Paul.
to-
Yeah. And good day, everybody. I appreciate the opportunity to talk to this group. I think Paul said it well, that what we're seeing, and we see tens of thousands of manufacturers, both domestically and internationally. And, the first slide showing this scale, this balancing act is really what our manufacturers are feeling right now, right? And we work with kind of the gamut in terms of size of companies, from early stage to mature companies, and revenue sizes all the way through. So we see a lot of different aspects of it. All are, they have their concerns, and for them and for us, it's about risk, right? How do we manage the balance sheet? And right now, the supply chain challenges that our clients and our manufacturers are dealing with have kind of created a little bit of havoc on their balance sheets. It's created this bloating of inventory levels, and it's, they're feeling the effects of it now. Certainly on the banking side, banks are as rates go up, companies that were borrowing to support the increase in working capital are looking at it and saying, boy, this is getting even more expensive than we thought it was. Not only from just a use of cash on the capital side, on the inventory side, but now, the debt service related to it is increasing. So really kind of going back and rethinking, well, we have to kind of balance this out, making sure that we still have enough inventory to support our customer needs and to, potentially combat any supply chain disruptions, either that are still currently going on, or that they're either predicting or wondering if those are going to come to fruition. So it's a challenge. It's a tug of war between how do we get to the right levels without impacting our our results or our ability to serve our customers. So, I want to spend a little bit of time talking about, and I want to get into some case studies. And let me just reiterate, if you do have questions about anything, feel free either to simply jump in or put something in the chat. Happy to address anything as we talk through this. I know there's going to be some time at the end as well for a Q&A session, so we can certainly address any questions there. But I want to talk a little bit about what we're seeing and a couple of examples of how our clients have kind of refocused and made some changes to address this this inventory issue that they're dealing with. There's a lot of options, right? You're all financial executives and have a background in the accounting or the finance side of it. None are the magic wand answer. All of them have a play in terms of what companies can do or focus on. Obviously, attempting to sell it is the best answer. Not always easy. For some of the disruptions that we talked about in terms of components, right? Making sure you've got the right components to be able to sell, making sure that you can get it to your customers, and pricing obviously always plays into it. Paul had mentioned this kind of renewed feeling of going into Asia for purchasing and what once was really focused on pricing. Again, pricing is always an issue, but we're seeing the same things, that the end customer is putting less importance on the pricing aspect. It's always important, we get that, but less than what it was in the past, and really about availability and access to product when they need to buy it. So that's what we're seeing with our clients in terms of how they're dealing with the inventory, their inventory levels, and how they build their business model to help support that in a profitable manner. So I really want to talk about two pieces of this. The case studies I have really focus around the operational changes. And I'll get into a couple of examples that we've seen with a couple of larger clients in that realm. But I think I mentioned risk earlier. I'm an auditor by trade, also a tax advisor, and the fourth bullet point on here, the capitalization, is something that I think goes under the radar sometimes, and especially as inventory levels start to grow. It's easy for this idea of capitalized costs that are going into your inventory to go under the radar, or at least less focus goes on that. And I mention that just because we see it a lot in terms of risk as we're looking at financial statements and auditing those financial statements, as well as a tax opportunity, quite honestly. As inventory levels rise, and if companies aren't equally kind of managing their capitalization policy, we can see that just quantity rise also result in a cost rise just because of the capitalization. And I think it's something that I just wanted to mention, because not only is that a risk from a financial statement standpoint or an audit statement or an audit perspective, but it also means that you could be overpaying in taxes. If you're in a tax position, your inventories are rising, and I'll say artificially through of excess capitalized costs, there might be an opportunity as well to look at the tax implications of that. I'm not going to spend any time today talking about that, but we are seeing that as an opportunity and a real situation that our clients are dealing with. So it's a little bit of a result that people weren't expecting, the tax consequences related to it. But the key that I want to talk about, the two case studies that I want to describe, is really about how do you look at your inventory in a different manner. This first example is a company. They are a consumer product company. It's the products that they produce. It's high component, multi-component builds that have a lot of different SKUs, right? That goes into an end product. And what they were finding, and this is a domestic arm, a U.S. domestic arm of an international company, much of their product was being purchased from their international parent, and there was a new acquisition, right? So they were dealing with a lot of different aspects of managing the inventory. And what we were finding was, and what they were saying was, our inventory keeps growing, and it gets hidden a little bit by the supply chain issue, right? Of saying, well, we're seeing that with a lot of companies, inventory is rising. We need that safety stock or the just in case stock. And they're comfortable with that growth. Well, they get to the point where you're saying, well, is that growth in our inventory all good inventory, right? Is it, we've got a lot managed or a lot of capital invested in inventory, and ultimately is that going to be something that we're going to be able to turn? So we were looking at it from an audit standpoint and challenging management and saying, help us understand the makeup of this inventory. And that was a challenge for them, right? Just because of all the components and things like that. They had a lot of inventory, a lot of good inventory, but it was a situation where, use the shoe analogy, right? They had 10 shoes, but 7 were left-footed and 3 were right-footed. So the ability to utilize all that inventory to get it to the end customer was a challenge, just because of they'd have 95% of a component for their product, and the last 5 they were having some gaps. So we help them.
Brent, on the
yeah,
topic of rising levels of inventory, we do have a question. Is the rising levels of inventory feeding the inflation trends, and can we anticipate this trend to continue, and for how long?
Oh, good question. I'd say yes. I think that is driving some of the inflationary situations that companies are dealing with and customers are dealing with. I think it is, it's maybe it is a convenient excuse for companies to be able to use that as the mode, and it's being accepted by the end customer. How long it'll last? It's a great question. That's crystal ball stuff. I don't know. I don't have a feeling, just for the same points that Paul made earlier. As things start to I'll say wind down in terms of or equalize in terms of stocking levels at end customers and the need for this overabundance of safety stock, as that starts to even out, now you hear about other geopolitical and other situations that may add to that again, or create challenges, supply chain challenges going forward. So it's hard to say. Paul, I'd be interested to get your take on that, and what you think potential timing could look like on that.
So if all the commodities that we were talking about are essentially going down in cost, and if we make a broad assumption that the inventories that people have are elevated to the point of 6 months, to me, it sounds like you work through that inventory, you start purchasing your new things, and within 9 months that you could be at a new price point. And actually below potentially where you were in 2019 or 18.
Yeah. Which does create another risk, right? If companies aren't getting through all of their inventory, now you've got inventory sitting in the books at a higher rate than you're able to sell it for, or at least the impact on margin could be impactful to a company if we do see that trend, and if inventory is or if some of the material costs do truly go down and stay at that level. That's a good point, Paul. So, with this particular company,
Brent,
please.
Before you move on, can I trouble you? You mentioned briefly something about tax and inventories.
Yep.
In Asia, inventories are not taxed, and I haven't been working in the U.S. since the 90s, but back in my time, at that point, there were taxing inventories. Can you spell that out for some of our members that may not realize that? I mean, and I don't even know if they're still doing that, but are they still taxing inventories in the US?
Yes and no, depending on, so on federal jurisdiction, no, right? There is no specific tax on inventory. When you get into local jurisdictions by state, there are some taxes that are built off of assets that are held in particular jurisdictions, so that can create it. I think what I was really referring to is the capitalized costs that are going into inventory that in a roundabout way impacts your profitability, right? If you're allocating more cost to capitalized inventory, that's reducing your expenses, reducing your cost of sales, because you're allocating that to the balance sheet rather than the P&L. So I think what that can create is a situation where if you are over capitalizing burden costs, you're basically increasing your operating income, right? So you are not only increasing the risk on your balance sheet in terms of excess inventory, but that has a direct effect on your P&L as well. So it's not necessarily that they're taxing the inventory, it's the effect on your P&L of overcapitalizing or potentially overcapitalizing your costs into inventory.
Yeah. Okay. So over absorbing overhead into your inventory.
Correct. You got it.
Got
You
it.
got it.
Thanks.
You bet. So, back to this consumer products company, what it really came down to, and I think part of what our teams did to help management look at this is taking a deeper dive and understanding really the communication and the visibility between the parent company that was supplying the parts, operating company or domestic US company that was receiving the parts, and the configuration of their products to ensure that what they were receiving matched up with what their demand was, ultimately what their demand forecast. And there was not good communication all the way through. So we had helped this company develop that, really putting this pipeline, this portal together to help their systems communicate better, to understand what the components, right? How the components match to the BOMs the bills of materials that they had or that they were projecting to have, to make sure that they had kind of the right mix of the SKUs in place and at the right levels to meet the demand that they were forecasting. And it was interesting, that they have sophisticated ERP systems. They didn't utilize them, and we see this a lot. Those ERP systems have a lot of horsepower. Most companies use about 40% of that horsepower, and the communication or the visibility to that information just wasn't where you'd think a company of this size would have it. So kind of end of the day, and this process took about just over a year, well, it was almost 2 years, I believe, in getting to this, but they pulled $50 million out of their working capital just by better planning or better identifying what the right quantities of the right product that they needed to have in stock to match what the demand was. So again, not rocket science, but getting to that level of detail was challenging. And I think that's where, getting a deeper dive into some of the digital information that was available is really what helped this company get down to levels that they were more comfortable with. So that's first example. Second example, this was a industrial distributor, product distributor. So they purchased a lot of product overseas, a lot of different SKUs and a lot of customizable SKUs for their end customers. And what we saw was this trend in which the inventory levels continued to grow, and really at a disproportionate rate to what their revenue was growing at, and kind of the same topic, same comments that management made. We have to have this inventory in stock to be able to sell it. We're concerned, it's taking 3 to 4 months to get product when it's ordered. We still have availability of it. It wasn't, some of the product lines, especially on the electronic side, they weren't dealing with those outages. It was just really kind of the timing of getting it into their facility. So they were, continuing. We saw this trend of inventory continuing to grow, and what we found, and again, we took a deeper dive into what the product makeup was that they had, and really focused on how much inventory they had in comparison to their sales, not only current sales but forecasted sales. And what the CFO was, looking at and understanding and hearing from his counterparts in production and sales is, yes, we need to buy more. We need to have the safety stock. We need to, we have customized products that are specific, or we're making them customizable to a specific customer. And what they were finding was, they had inventory where they had 6 years of supply in their inventory, right? They had 6 years of demand sitting in their inventory, and it was eye-opening. Now that wasn't across the board, every product line, but there were some that they're just saying, we're never really going to be able to sell this, right? It's going to be obsolete by the time, or different customers change, and they were at risk, right? They were over purchasing based on a soft demand indication from a customer. Their product that they were buying was customized, or they etched it with a customer name and things like that. So they made it customizable to their end customer. And it led to this bloating of their inventory that created a real risk for them. So again, we spent some time identifying where those pockets of inventory risk were, as well as looking at some production changes. I mentioned some of the etching of the name of their end customer, right? The end customer wanted some customized branding on the product, which was fine, but we helped the company really look at it and saying, well, do you need to do that on the front end, or can you do that when it's ready to ship, just to make it more available, so it wasn't a customized product until it needed to be. And again, it was probably a 1.5-year process. They brought their inventory down by about 20%. It's about $10 million of working capital that they brought, that they converted to cash, that really helped them kind of identify or free up that excess cash. Didn't impact their ability to serve the company, didn't impact their ability, or their customer, I should say, didn't impact the ability for them to grow. But it did help them identify where their risk was. And I think that's what we're seeing is kind of the recurring, not message, but I think the recurring opportunity for our financial executives in our companies is really kind of taking a deeper dive to understand what the makeup is of the inventory. It's easy to kind of rest on the thought that inventories are growing and we're just comfortable with that. But I think when that happens, things get missed. And I think really taking a deeper dive to understand what their inventory makeup is a big opportunity to manage that risk, and hopefully not get back to this more of a just-in-time scenario rather than the excess inventory that they have on hand. So that's really what we wanted to at least bring to this group, and we can open it up for any conversation. But I think just to kind of wrap up what we've talked about, certainly there's volatility, always will be, and risk associated with that, right? And as we talked about, there's a balancing act between having enough versus having too much, and how do you make sure that by not having the right inventory, you're not putting the company at risk, both from a customer standpoint as well as just from a business standpoint, making sure that you've got the ability to grow with the needs that are there without having interruptions in the supply chain. Yes, pricing is always an issue, but I think customers are getting more comfortable right now, at least for a time, for the time being. We'll see if that starts to change with some of the recessionary trends we're seeing. But that's less of a driver. It's ability to have the right product at the right time, but also de-risking it so that we don't have too much of unusable inventory. And then it's really about just doing that, managing to the levels that you need, and making sure you have the right product available, and not getting too aggressive, and using the mantra of, hey, we have to have more inventory to combat the supply chain. Having more inventory is okay as long as it's the right inventory. I think that's really the message we want to share. I'll pause there. Paul, any other comments?
No, so Brent, I think that's great, and your expertise is showing through. So thank you for all of those comments. And I do, one of the things as you were talking about it may be obvious, but it's sort of business back to basics, and we can't blindly just be doing the things that we are doing. Yes, supply chains are difficult, so let's order a lot more stuff, but the devil is in the details.
Mm-hmm.
And focusing on what we can control and maybe recognizing that there are trends out there that we have to be aware of, but largely these geopolitical things are out of our everyday man's control. And what is it prudent to do? Moving some of the eggs out of the basket geographically, or into other baskets geographically. I think those are important things to take note of. They're relatively cheap to do, and it can mitigate some of the risk. And I do think it's about mitigating the risk, but essentially it's just overall this is kind of a big math problem. And getting back to the basics on some of the accounting and making sure that we're aware of what's happening with commodities, so we're not over ordering into the teeth of a declining price and supply chain cost, which is related to price as well.
Right.
And right sizing those inventories and preparing for the next upturn. And so I think that's what we're seeing with all of our clients. And I think that probably resonates with the group, and happy to open it up to questions or Daniel to take the reins.
And let me just add one more piece to it. I think I mentioned this earlier, but the capital markets are seeing this trend as well. And I know, on the banking side, right, as companies are borrowing more to support this working capital, I think there's more scrutiny that the banks are going to be putting on the levels of inventory and the amount of, that inventory is going to be an asset that they're going to lend against. But their borrowing base could be impacted if a bank comes in and does what I was speaking to, which is let's kind of evaluate the detail of your inventory. And if you've got lagging inventory or aging inventory, many banks aren't going to lend on that, or they're going to take that out of their borrowing base. So it can put companies in a little bit of a pickle in terms of their ability to borrow, or what their line availability could be. So another aspect to be mindful of.
Thank you, Brent. So we do have a question that came up during one of your case examples, Brent, and I'll read this out. A great example with the shoes. Are inventories being more impacted with actual production of the inventory items versus log jams in the supply chain, such as jam ups at the US ports and or group transportation issues, which are delaying getting inventory to the company and users?
Yeah, great question. We're actually seeing it on both fronts. And part of it is on the production side, it's the lack of resources, right? Just the lack of people in the workforce. I think that's creating some challenges just operationally to get product out the door. That is certainly part of it. I think what we're seeing just in overall inventory levels, that has historically been the mix of the inventory they have, right? The availability of getting the right inventory in, whether that's stuck on the ports, or from vendors that they're not able to get the necessary parts. I think that's probably the bigger issue right now, and continues to be. I think that's what the issue has been over the last probably 12 to 18 months. The resource constraints in terms of people is going to continue, and I think that is that's a challenge, right? I think today, that quite honestly, I think that's going to be more of a future challenge in terms of production than the supply chain issues that they're dealing with right now. But I see that on the horizon. It's going to continue to grow, and I think companies are trying to figure out how do we change the way that we produce, so that we don't need the people that we believe that we need to do this. So the automation side is significant. Now that also leads to a challenge because a lot of the automation equipment is not easily available right now. It will be, but I think people are rethinking that and getting more comfortable about automating more and more processes. They have to. They're just the people aren't available at this point.
Thank you, Brent. All right, so at this moment, we're gonna have the floor open for any questions. If anybody wants to ask anything to either Paul or Brent.
I got a quick one, guys. Recently, we are starting to see a trend. I think it's the second or third company Daniel and I have been dealing with where they're using the idea is to get the actual producer to make more money, but and the middlemen to reduce the risk for the middlemen. And so what we're seeing is are these blockchain solutions where the end buyer, and I can give you an example as coffee or a cow or something like that, in a restaurant scenario, well, they will purchase a certain type of product ahead of time directly from the grower. They will use blockchain and smart contracts to ensure that every single step of the way is through the supply chain. It hasn't been switched out for a substitute product, and they're delivered the final product, and they are paying fees along the way to the different processors, but they're only paying a fraction because the actual title of the goods is not shifting, for instance, from farmer to slaughterhouse to distributor to a restaurant. The restaurant is buying the cow directly from the farmer. Are you seeing anything like that? And what do you, I mean, that seems to be reducing the risk a lot with the blockchain scenarios. Are you guys seeing anything like that?
Yeah, I can add my take. I think, yes, we are, right? So direct to supplier or producer is something more and more companies are trying to get to. For smaller companies, it's harder, right? They either don't have the expertise, they don't have the bandwidth to be able to manage that. I think as companies are getting larger, that's probably easier when they have the resources to be able to do that. But that is the trend. I think that middleman, wholesaler, distributor is a hard place to be. And I think going forward, it's going to be a harder place to be just because of the ability, of more and more companies, certainly with technology, and direct feed to the supplier or the producer. The other side of that is, a producer's ability to serve all of those different companies, right? So everyone's trying to reduce the number of vendors that they're working with. Same with customers, right? If they can minimize that and get the same throughput or more, it just makes life easier. As a producer, that's a shift in their model, right? Instead of going to a distributor or a wholesaler, which is, they've probably built that over time. They've got that connection. They know that they're going to get paid. You're opening it up to, hundreds or thousands of customers. Now you've got to balance that risk out as well. So depends on a producer's ability to support that as well. Paul, are you seeing much of that?
That's way more sophisticated than how our supply chain runs, at least now. We're breaking rocks.
Yeah.
No blockchain involved anywhere in our supply chain right now.